Today, we'll be discussing a recent event that shook the financial industry. Silicon Valley Bank, one of the largest tech lenders in the US, has collapsed, triggering a bank run and capital crisis. In this video, we'll dive into the details of what led to this crisis and the implications it has for the broader financial system. Silicon Valley Bank, a tech lender based in California, was closed down by state regulators on Friday and put under the control of the U.S. Federal Deposit Insurance Corporation, FDIC. The FDIC is acting as a receiver, which typically means it will liquidate the bank's assets to pay back its customers, including depositors and creditors. The events leading up to the bank's collapse began on Wednesday when SVB announced it had sold a bunch of securities at a loss and that it would sell $2.25 billion in new shares to shore up its balance sheet. This triggered a panic among key venture capital firms who reportedly advised companies to withdraw their money from the bank. By Thursday, the company's stock had plummeted, driving other banks down with it. By Friday morning, SVB's shares were halted, and the bank had abandoned efforts to quickly raise capital or find a buyer. Several other bank stocks were also temporarily halted, including First Republic, PacWest Bancorp, and Signature Bank. The FDIC's takeover was unexpected, as the agency typically waits until the market has closed to intervene. According to Better Market CEO Dennis M. Kelleher, SVB's condition deteriorated so quickly that it couldn't last just 5 more hours. Its depositors were withdrawing their money so fast that the bank was insolvent, and an intraday closure was unavoidable due to a classic bank run. The decline of Silicon Valley Bank can be traced in part to the Federal Reserve's aggressive interest rate hikes over the past year. When interest rates were near zero, banks loaded up on long-dated, seemingly low-risk treasuries. But as the Fed raises interest rates to fight inflation, the value of those assets has fallen, leaving banks sitting on unrealized losses. Higher rates hit tech especially hard, undercutting the value of tech stocks and making it tough to raise funds, Moody's chief economist Mark Zandi said. That prompted many tech firms to draw down the deposits they held at SVB to fund their operations. Higher rates have also lowered the value of their treasury and other securities, which SVB needed to pay depositors. All of this set off the run on their deposits that forced the FDIC to take over SVB. So, what does the collapse of Silicon Valley Bank mean for the broader financial system and the tech industry? Only time will tell, but it's clear that the Federal Reserve's interest rate hikes have had a significant impact on banks and businesses alike. We'll be sure to keep you updated on any developments in this story. Thank you for watching, and don't forget to subscribe to our channel for more financial news and analysis.